Good everyone, it's your favorite mentor IOC. This is a new lesson in the series, our backtesting series, where we are going to be learning from history. So in this series, I'm going to be putting so many things together, showing you how you should go in your analysis as a trader. Now, it became a concern to me when I was even starting up my career in the foreign exchange market that I never saw relevant informations out there online to be able to tell me how do I go and learn from history, because those who would not learn from history, they always pay for it. So in this series, I'm going to be going over my chart. We're going to be checking a few pairs, and I'm going to be going over the chart, telling you how to come in at every point. What do you do when you see this? What marks up your confluences? And it just putting so many things together and telling you how to readily engage when you come into the marketplace. So I'll be going over this lesson. I'm going to be making each of the lessons in the series very brief for you, so that you're going to be watching them, putting them to use, and seeing them play out in your trading career. So let's just jump right into the course. Okay, so we'll be going right to our chart, and I want you to get your notepad, your pens, and every other thing that is needed for you to be able to get everything I'm going to be saying down. I want you to also rewatch this particular lesson. You want to watch it over again, put it to use, check it on the pairs that you are trading right now. I want to be able to check all these things, go over them. It's very, very important. It's very, very important, because I myself have backtested enough. So whenever I see things come out in my chart, whenever I see things come out in price, I don't get surprised. I just know what I'm to expect, and I know how to engage going forward. So I just want to be able to tell you that, to be able to put everything I'm going to be saying down to note. Okay, let's jump right into the chart. Okay, so this is the dollar index. And as you know, the dollar index is our benchmark to be able to determine price direction. The dollar index being our benchmark does not in any way mean that if the dollar is selling, we want all our foreign currencies like Euro USD, GBP USD, NZ USD, AUD USD to buy. No, if the dollar is selling, yet on a normal scale, they are meant to buy. But there are times whereby we experience what is called relative accumulation and relative distribution, whereby they show that they don't want to follow what the dollar is doing at that particular point. Yes, it will show it based on its independent price action. At some point too, it will now come back and follow what the dollar is doing. So in analyzing your pairs, you want to do them individually. You want to analyze dollar alone. If you're trading Euro USD, analyze Euro alone. If you're trading GBP, analyze GBP alone. Then at certain points of market protraction, you want to be able to come in and check the point of, are they validating to go the same way? Are they going symmetrically? Are they going in the same way, or am I expecting a relative accumulation and relative distribution? So all these terms I'm using here, I know that some of them might be new to you, but they are all available in the academy. So I'll be using this term because of that's how I can express myself, but I will try as much as possible to make you understand what I'm trying to say. So what I said initially was that if the dollar is selling on a normal, you have to expect your foreign currencies to buy. But there are some times that the dollar is selling, no doubt, the dollar is selling, and you will see something like this on, let me say, GBP. This is Euro. You will see something like this on GBP. GBP too is also selling instead of to buy. But this does not readily mean that, okay, that at this point you say that, oh, that the dollar is not your benchmark for determining your foreign currency direction and you just leave it by the side. No, at some point where the dollar still continues its sell and the euro still continues its buy, a point will come whereby they will have some confluences and the GBP will start following the buying strength of it, and that means the dollar weakness have now affected the GBP, and the GBP have seen here to be a point that it went to validate its reason for going short before going pari passu with what the dollar is doing. So I believe you understand me. That's what I mean by relative accumulation and distribution in a layman's way. So in this particular lesson, we are going to be looking at the dollar index. We're going to be looking at a dollar index, and we're going to be looking at all these things to be able to know what characterizes our base to be able to determine other foreign currencies market direction. So I'm going to be starting from 2021. I'm not being selective here, but I want to start from 2021. At some points, we'll either go front or go back, but I want us to come front for the dollar index here from 2021. So this is 2021. 2022 rather, sorry about that. If we say 2021, it's here, but 2022 is around here. Okay, this is 2022. So I want us to be able to be checking the reasons for market inclination and declines in the marketplace. So this is the year 2022. So I'm going to be picking point of interest for you as a trader in this particular year. We're not just going to go from January to February to March. Points of interest that are very, very important, because there are some points that whenever I do my back test, there are some points that actually catch my attention. Understand? There are some points that catch my attention. In this whole rally like this, you can bear with me that this point is a point of interest. Why did the market stop at this point and start to decline at this point? So this is where I want to be able to talk on today. So yet we'll talk about all this, but it's very easy for you to say that, okay, the market is expanding, retracing, and it's making further expansions, retracements. It found support here, expand, retrace, expand, retrace, expand, retrace. So, but at the point whereby we go for a reversal, that's where I want to highlight on today for today's class. Okay. So we start from a higher time frame. I love using the 3 months time frame. So I love to tell my students that, first of all, look at the grand scheme of things. The grand scheme of things being that you want to look at price from an overall scale. What has the market been doing? We saw that the market went high, made an all-time high, came down to break a low. That means the dollar confirmed its bearishness in the marketplace by doing this. And also it has gotten liquidity. So once again, all these terms I'll be teaching here, I'll be using here, are terms that for some of you, it might be new, but I teach them practically and I go deeply into the academy. When you come to the academy, you will learn all that. So the market went for liquidity here, that rebalanced that. The quest for liquidity, like we know, the market goes up and down for 2 main reasons. One is the quest for liquidity, and 2 is to rebalance an imbalance. So the market either goes for quest for liquidity or to rebalance an imbalance. And it's rebalancing an imbalance at your premium and your discount prices. Also uses support and resistance to be able to do that. So The market came and confirmed its bearish nature by doing a break in market structure as at this point. So this is our BMS. Sorry about that. So the market did a BMS. BMS as at this point, it rallied up, went to a premium, and sold down. So all these things are things that you should be seeing in the marketplace. So the market went to a premium and sold down to furthermore confirm the BMS we have in the marketplace. Now, if it has done this particular range, it worked on it here. If it has done this, where is our next range of interest? This. So the market went up to rebalance that particular imbalance in the marketplace and sought for liquidity here. It sought for liquidity here and rebalanced the imbalance as at this point. This is a quest for liquidity. It went for liquidity above these highs. And rebalance the imbalance of this range. If you go to the 6 months, you will see things much more clearer. You can see that. You can see that. Let's look at the 12 months. You can see that. So the market went to rebalance and imbalance as at this premium, because when you have highs here, that the market has created and it wants to go down, sincerely, it wants to go down. It came, met some form of support that were higher time frame levels, pushed it up, a rejection block, retrace down, rejection block. And when it has highs here to go for quest for liquidity and it needs to rebalance and imbalance on this range, you look at this fair value gap here. So this was the point it used to call the market direction going to the downside. So this already should be your point of interest. This already should be your point of interest, but where exactly at this point am I going to look to know that the market has started going short? That is a question most persons will be asking right now. So if you look here, we have a fair value gap. The middle of the fair value gap, we term it as consequent encroachment, which is the minimum expected fill when the market wants to either go long or short. In this case now, short. And this is our bearish order block. This is our bearish order block. The bodies of the order block started from here. So we want to be able to put that to note. So this is our 3 months level. Then we break it down to the monthly time frame. Now, I want to point out something that when analyzing your DXY, the euro also comes in handy because it gives you clarity to what you want to see in the marketplace. It gives you clarity. There are sometimes you might not really see something very, very clear on the dollar index, but the euro will show you with a clear depiction where the market is going to. So if you just check the euro USD, if we just check the euro USD, we don't have much data like the, let me just check FXCM. FXCM usually produces a lot of data. Okay. So just those are my backtesting stuff I do. Okay, now you can look at how simplified the euro is. The euro went high, took out liquidity, and is retracing now to fill an imbalance. Where is our point of interest? We look at here, this fair value gap here, and we have the other block beginning from here. So as at this point, it's called it long. So it gave more clarity on the euro, and we can also use that to track the dollar. If you go to the 1 month time frame, you're also going to see with much clarity why it went that place. Look at this, is your fair value gap. It read it, and consequent encroachment, like I tell you, it is 50% of the fair value gap. It hit it here nicely, a mitigation block, and boom, it went up. So there are sometimes, just like I said, that you will not see with much clarity on this pair, particularly the dollar index, but you will see it clearly on the euro. Sometimes you will not see it clearly on the euro, you will see it on the dollar, because the euro is the only pair for me that follows the dollar very, very well. Other pairs like the GBP2 follows it, but sometimes you will see relative accumulation and distribution like I talked about. So this is our higher time frame level that we are looking at, and we are day traders. So how do we frame that into our chart and start looking for the reversal? When do we know that the reversal has come to play? Now, at this point, I want to also inform you that you want to be very, very careful. Let's point out the resistance objectives we have in the marketplace. Let's point that out. Okay, I'm seeing here a low. I'm seeing a low here. And I'm also seeing this rejection as at this point. So this, let me make the candles red to tell us that it's from our weekly levels. Okay. So as a day trader, where do we look out for we to know that the market has reversed? And as at this point, this all-time or long-term highs and lows, you want to be very, very careful as to determine the market's direction. I myself, in times like this, I want to be able to not be able to be coming to the marketplace on a daily basis. I just want to look out for things to actually come out and ensue. Let the market leave the footprint for me. I see it clearly and I come into the market to trade. So I don't press for my objective that much. If it's in a range, I can do very, very well in that. Even outside the range, to also do very well. But in terms of premium objectives like this at all time or long-term highs and lows in the marketplace, you want to do it with care. You want to do it with care, particularly as a short-term and or a day trader. You want to do it with care. You don't force your way in. You don't force your way in. You want to do it with care, because I normally teach my students something, that this point in the marketplace is the point of interest. This point. The algorithm has read this point as the point of interest. Okay, let me make it more clearer. The algorithm has read this point as the point of interest in the marketplace, and this is on a higher time frame level. So the algorithm has read this point as a point of interest. Now it can do something like this. The market can do something like this. It can go and make this high that has made now, come back and still enter here again before going down. Because of it is seeing this point, this region in price. The market operates by time and price. This is the region it is seeing that it is that the market wants to go before it displaces down. But you as a short-term trader, you don't have that kind of liquidity to just place your trade here and put a stop loss above here. No. So you wait for things to unfold, particularly on this daily time frame. You want to be able to see things unfold very well for you before you come in to trade. So I'm going to be analyzing here because, like I said, I don't want to make the video too long for you. So this is the point of interest in the marketplace. How do you know that the market wants to reverse? Now, how do you know that the market wants to reverse? Now, for point like this, I look out for reversal objectives. I look out for reversal objective, things like stop run, things like my reversal candles. I want to look out for reversal objectives. So I said I look out for things like stop run. I look out for my reversal or end of manipulation candle. What do I mean by end of manipulation candle? End of manipulation means that on the higher time frame, particularly the monthly, weekly, and daily, if you see a candle raid, when I mean raid, I mean it has taken out the previous candles high and low, just like this, high and low. It tells you that it is the end. It has shown that this candle is the end of manipulation toward that side. It can also be based on the current institutional order flow of the market or the current bias that the market is going with. So, but it has showed you that that is the end of the manipulation that the market is going to do. So this candle has shown that this is the end of manipulation to the downside, begin to look up. So even if I see the market come down to here like this, I can buy this thing readily and put my stop loss here and look to take it out. As soon as the market takes out this candle that did the end of manipulation or the reversal, the end of manipulation, as soon as it takes it out, this candle is rendered void. So this particular concept has been rendered void once the high has been taken out. In terms of the selling objective, once the low is being taken out, the candle has been rendered void. So depending on the institutional order flow, depending on the current the current bias and the nature of the marketplace at that particular time. You see it also here. This candle took out the previous high and low. It tells you that it is the end of the manipulation. It came to fill a fair value gap and boom, it went up. It still came down again, but not below this one. Although, so look at it here again. This candle took out the previous high and low. It expanded going up. Now, look at it here. The market, this red candle took out the previous candle's high and low, and it reversed down. And it's one of our concepts in academy that the Monday to Wednesday makes the high of the week 70% of the time in a bearish week, and the low of the week 70% of the time in a bullish week. So if I see that readily, you want to take what I just said down to note. If I see that Wednesday have come to raid Monday and Tuesday high, and I've created that end of manipulation or reversal pattern for me, it tells me that, okay, that I can now go into the marketplace, because most times I don't trade on Mondays. And if I came here to see this thing, I would not have even traded on this day. So I will see this on Wednesday. I will now go to hunt and come in preferably as at this point on Wednesday when I've seen the reversal. Understand? As at the point that the market took out this Tuesday low, yeah, on my lower time frames, I can come and begin to hunt more objectives to go short still on this day, the Wednesday. And preferably again on Thursday, we see a retracement down into the current range that the market have created from high to low. It went into the range and sold down on Thursday, and also expanded down to take out Thursday's low on Friday. But now we have come into the discount and also a bullish order block here. Understand? So a bullish order block, not in the sense that it changed the market direction, but a bullish order block in the sense that the market is attacking the downside. So it's seen it as a support. So it's seen it as like speed bumps is going to make. So when you sell here, you cover up down here. Understand? So this is what the market did as at that point. So let's just go down into the lower time frame to check this particular point in price. So we are looking at October 2022. Okay, so October 2022, Just like I told you here, that on Monday for me is a silent day, so we're not trading on this day. On Tuesday, you come to see that the market going to take out Monday's high. Fine. And now, once you see this, you know that there is still pending a draw on liquidity as at this high here. So there is a draw on liquidity as at this point. These are things that you see clearly on your lower time frames when you come here. So there's a draw on liquidity at this point. Now, from our higher time frame objectives that we have seen in the marketplace, from the higher time frame objective, all this line that we kept from the 3 months down to the weekly, the fair value gap and what have you. So from this objective, we are expecting a reversal. So like I said, it's a region in price that the market want to displace, but based on the fact that it is higher time frame levels and you are a short-term trader, you don't have that much liquidity to place and keep your stop loss a far distance away. No, you have to wait for the market to show you footprints of what it wants to do. So the market went and seek this place as a draw on liquidity. So we call that as draw on liquidity. So the market saw that as a draw on liquidity. You want to search for reversal objective. So the reversal patterns, just like I told you, when the market takes out the previous high and low of the previous day on the higher time frames now, daily. So the market came to read Tuesday's high during a short session on Wednesday. So the market came and rated Tuesday's high on Wednesday. And where is Tuesday's low? This is Tuesday's low. Okay, we have already marked it out. This is Tuesday's low. So let's put it green. So the market took out Tuesday's high and low. So as at this point, it is a point that have given me in now I will wait for the market to objectives that will give me once again. So we see fair value gap and all the rest. So where do we know where to actually give our shot from? Now we pull our fib. So at 50% or above, it indicates that we are at premium. From 50% and above, so the market took out the low here, the previous daily low here. So as at this point, we want to be able to check where will it come to rebalance before we look for a sell. We have gotten ours our signal here by the market taking our previous daily's high and low. So where we look on to hunt for our entries. So what we do, we put our fib here at 50% and above. It's our premium objective. So this, we have 50% here. So above that, we start to look for premium objective. Now, I want to urge you, all these levels are, they are my levels to be able to look at for premium objective, my 70.5, my 79, and my 62. These levels are levels I look out for objectives. These other ones, my 0.75 and my 0.25, I look at them in terms of quadrants. Now, these levels must not actually be met, but they are levels that I look for most times when I know, depending on how the market is going for liquidity and how well it wants to displace from that particular region. Now, the market wants to displace from this particular point, the particular point that we have seen as a significant point in the higher time frame. So it must not readily go and fill up that objective, but above 50% is our premium objective one. If you go to your higher time frame from your 4-hour and your daily, you're going to be seeing the objectives is looking at in terms of support and resistances. But now resistance because of we want to sell, to be able to hunt for your shorts. So you look at all those resistant objectives. So now look at what we have here. We have what? The filling of a fair value gap. A fair value gap being filled. All these things, 1, 2, 3, 4, 5, 6, they all form a bearish order block in the marketplace. So this here is the filling of your fair value gap, and you go short. Then you look to hunt the downside. So look, the market came and we did still in that same week, came and filled a fair value gap before consolidating to end the week. So this is just a short one for today. It's just a short one for today. I believe there are so many concepts I've brought into light here, which going further, I'll be releasing more content to be able to break everything down in pieces for you. So I'll be releasing content that will teach just on premium discounts, on liquidity runs, on time and price. I'm going to be touching each and everything independently, but when we come to backtesting series, I'm going to be putting everything together, and I assume that you already have a pre-understanding of whatever I'm going to be talking in regards to the concept we are using here, which is institutional concept. So, like I said, I don't want to make this particular lesson long. You want to go back and check this and know how well you fit in before you can be able to come into the marketplace when the market has gotten to a higher time frame objective to be able to displace price going down. So I'll see you in the next lesson. Have a nice day. Thank you very much.